Welcome back to the Deep Dive. Today we're going to talk about a market performance that kind of redefines what success even means. We're tearing into a review that documents returns so big they almost seem fake.
They really do. We've been going through this 2025 performance review and the 2026 strategy document that followed it. It's all focused on the Ghana Stock Exchange, the GSE.
And this is more than just numbers on a page, right?
Oh, absolutely. It's a fantastic case study in, relative performance and what it feels like to try and keep up when a market just explodes.
So our mission for you today is pretty simple. We want to take this huge, eye-popping headline number and translate it. What does it actually mean for, a real person's portfolio? And then what do you do next?
Exactly. The strategy part is key.
Because the top line figure from this source material about the GSE in 2025 is just, it's wild. The market was, and I'm quoting here, absolutely on fire.
And that's not just hype. The data is right there. The GSE Composite Index, it ended 2025 with a massive 79% year-to-date return. 79%. Let's just sit with that for a second. If you're trying to understand global markets, that one number for that region, that's the story.
It is. A return like that puts it right at the top globally for the entire year.
So if you had just, bought an ETF that tracks the index?
You would have seen your money grow by nearly 80%.
Yeah.
The source makes that exact point. I mean, that doesn't just beat inflation. That is a generational kind of wealth creation event in a single year.
Okay, let's unpack this. A 79% return for an entire index. That doesn't just happen. What was the engine behind this? What does the review say?
Right. That's the first thing you need to be well informed on. It really comes down to two main things, things you often see in these commodity-heavy emerging markets.
Okay.
First, a huge recovery in key resources. For Ghana, that means gold and cocoa. Prices were soaring, and those sectors are, heavily weighted on the GSE.
And the second factor?
A stabilizing currency.
Yeah.
That encouraged a lot of foreign institutional money to come back into the market, chasing those commodity plays. So it's a perfect storm. You have a commodity supercycle hitting at the same time as a currency story. And that just lights a fire under everything, especially the big banking and mining stocks.
Precisely. And it happens fast. Which leads us to the real dilemma here.
Which is?
That 79% figure, it's no longer just a result. It's the new standard. It's the benchmark.
Ah.
If you're an investor in Ghana in 2025, every single move you make is now measured against that number.
So if the average person, just by buying the index, made 79%, then anything less than that, even if it's a great number, is technically a failure.
It's a failure in relative terms.
Yes.
And that distinction is everything. Let's say you made 50%, an incredible return anywhere else in the world.
You'd be thrilled.
But in the context of the GSE in 2025, the story is that you underperformed. You were great in absolute terms, but you lost to the market. That's the key idea you have to get your head around.
And that idea, that difference between absolute and relative success, that brings us to the most human part of this whole story.
It really does.
We shift from this huge market euphoria down to the personal and I think, frankly, painful reality for the person who wrote this review.
Yes. So after laying out this massive 79% index return, the author just comes out and says it. Their own personal portfolio performance for 2025.
More than?
24%.
24, okay.
Yeah.
So let's be clear. In almost any other context, getting a 24% return in 1 year is phenomenal. You are crushing it.
It's a wealth accelerating return, no question. But the author doesn't see it that way. They state very flatly that they, quote, underperformed the market.
And that's the aha moment for anyone reading this or for you listening. You can make a very real, very significant 24% gain and still feel like you failed.
Because the high water mark was 79, it just completely changes the psychology of it.
It's that gap, that 55 percentage point gap.
What's fascinating is thinking about what that gap actually means in dollars. The source doesn't give numbers, but let's just imagine. You start with $50,000. Your 24% gets you to $62,000. Not bad.
But the benchmark?
The benchmark gets you to $89,500. That's over $27,000 in, opportunity cost. That's what stings.
Right. It's the money you feel you left on the table.
Yeah.
So that leads to the big question, the one the author asked themselves. Why? Why was the gap so big?
And then the answer they give is, It's so simple and so common. It's a classic story for investors.
What is it?
They said, I only started midway through the year, so I missed that early momentum.
Timing. It
Yeah.
always comes down to timing. But what does early momentum even mean in a market that goes up 79%?
Well, it means that the biggest, most explosive gains probably happened right at the start of the year. We're not talking about a slow, steady climb.
This was a rocket ship.
Probably, maybe some big policy change happened or some huge earnings surprises from the big commodity stocks in Q1. That's when the market gets re-rated.
So if you missed Q1 and Q2, you missed the steepest part of the curve. You're buying in after prices have already shot up.
Exactly. The big valuation gap has already started to close. So even if you're a great stock picker, you're starting from a higher base with less room to run.
And the penalty for missing those first few months is, well, it's 55 points of performance in this case.
Which is just a brutal lesson. In these kinds of markets, timing the start of the rally is almost everything.
But that lesson, that pain, it seems like it directly powers what comes next.
It's the fuel for the entire 2026 strategy. They're not just writing this off as a learning experience, they're trying to fix it.
And this is where it gets really interesting for me. This is the pivot from looking back at 2025 to looking forward. They've learned that absolute returns don't matter if you're not beating the index.
Right. And so the goal for 2026 is laid out, and it's completely unambiguous. It says, the goal for 2026, close that gap and beat the benchmark.
Beat the benchmark. That changes everything. It's a much, much harder game to play, isn't it? Especially after a year like that.
It's a huge shift in mindset and in strategy. You can't beat the market by just diversifying. Diversification helps you match the market.
So to beat it, you have to do the opposite. You have to concentrate.
You have to make convicted bets. You have to find a few sectors or even a few specific stocks that you believe will outperform the average. It mandates taking on more risk.
So after a 79% run-up, where do you even look? The odds of the whole market doing that again are tiny.
Exactly. That's the critical thinking part. You have to figure out what the market is still getting wrong, even after this huge rally. Maybe there's a sector the big institutions have overlooked, or a company that's still undervalued relative to its peers.
So this is a fascinating trade-off for you, the listener, to think about. To chase this goal of beating the benchmark, our investor has to accept more risk, more variance than the strategy that gave them that very solid 24%.
They're moving from a good but not great outcome to a strategy that could lead to a truly amazing outcome, or a really bad one. And it's all driven by the psychological pain of that 55-point gap.
So to sum it all up, we have this incredible market explosion, 79% from the GSE. Then we have the reality of an individual's 24% return, which feels like a disappointment.
The cause is identified, missing that early momentum, that critical timing at the start of the year.
And the result is a new, aggressive strategy for 2026, all focused on one single goal: outperform that benchmark no matter what.
And that really brings home the two key takeaways. First, the incredible importance of timing in these high-growth, high-volatility markets. And second, that critical, often painful distinction between a good absolute return and your relative performance against a soaring index.
So, connecting this all back to the bigger picture, the decision to actively chase outperformance after a year like 2025, it raises a really important question for any investor.
It does. And this is the final thought we want to leave you with. After a market has already delivered a near-generational return, what does it actually take to beat it the following year?
Right.